Good morning, everyone, and welcome to our DAT IQ weekly market update. I'm live from the Adamo bunker this week. This is our update for Tuesday, September 26th, 2023. I am Ken Adamo, Chief of Analytics over here at DAT, joined by Dean Croak, who's our Principal Industry Analyst. We have a very special guest this week, one of our own. We have Group Product Manager Chad Kennedy joining us this week. Good morning.
Yeah, good morning, guys.
Good morning.
Great to have you back on.
Yeah, it's good to be here.
It's kind of funny, right? You can kind of track the progress we've been making in the projects that you're working on. But as you come on the show, you're showing us more and more new stuff, which is pretty awesome.
Yeah, I think this might be the third time.
Yeah. So we're going to show some really awesome stuff. I highly encourage you to stick around towards the end. Maybe plot this one in your favorites, especially if you're a shipper, because this is going to be really interesting for you to see a new look of what we're working on at DAT. But I'm really glad Chad can join us, and we'll be bringing him back towards the end. I'll be remiss if I didn't call out one Mr. Marcus Freeman, who is the coach for Notre Dame, who seemed to throw a jab at Ohio State about academics, and they failed to count to 11 twice on Saturday. Is that a coincidence, Dean? Or do you think that's maybe indicative of a slipping program over there in South Bend on the academic front?
Yeah, it's not that hard to count to 10, right?
It is, yeah. He got to 10. He didn't quite get to 11, which is problematic. But we'll leave that alone. I think that's all I'll probably say this week. Lou Holtz has already caught enough crap, so I'll leave him alone as he enjoys his life of retirement. So let's get to that. Let's get to those points of the week so we can actually talk business and get Chad back on. All right. So we've got quite a bit going on in the freight market right now. Both internal to the market itself, and then we're obviously going to touch on quite a bit that's going on outside the market that will have a big impact on freight volumes. So let's touch on some of that. The market's stuck. That's the term I've been using. We comment that they're down, but if you look and zoom out far enough, they're pretty much just staying flat and very similar to where we were in 2019 from a base perspective. Why we think it's incredibly important to contemplate fuel when you're looking at these things is on an all-in basis, we're very close to where we were in 18, drastically different years, 18 and 19. And I think you can see why when you parse out those two things. Active van and reefer rates increased slightly while replacement rates turned low single digits. That's a good thing. We're seeing the air kind of come out of the sail there as things begin to normalize. American Trucking Association's tonnage index dipped slightly month over month. It was up slightly, but again, this pretty much rounds to zero. And I guess this is exactly what we'd expect. The ATA data is very heavily biased, and I mean biased in a kind of a objective way. I'm not saying it's a bad thing, towards large fleets. And just keep in mind, it's measuring weight. That's not measuring shipment counts or expenditures. But it is a very good barometer. And you can kind of see a bookend to that, which is the cash shipment index. That's up 0.8% month over month, which is seasonally adjusted. And then the big one, again, the UAW strike entering the 12th day. I think we're up to 40 or so plants that are impacted. GM has already started to roll out some layoffs, with Stellantis, I believe, to follow. If they haven't already, I haven't watched the news yet this morning. But this is the big one. I'm sure Dean's going to cover it in some detail here. But if you're watching this program, if you're in the freight market, this is the one I would pay attention to most closely. So, Dean, take it away.
Yeah, thanks, Ken. We've been tracking some of the load posts out of the Ohio, Michigan markets. We're seeing load post volumes down this week. Loads moved are down also. So we'll have more of that on next week's show. Let's start off with the load to truck ratio and dry van. Load posts down last week, about 40% lower than this time last year. Equipment posts were flat last week, so not a lot of change in the dry van load to truck ratio. Was down to 2.56 loads per truck. In the refrigerated category, volumes down 30% the last month. Been flat since the July 4 break, mostly. Typically, we see an increase in load post volume over that time frame. So the fact that they're flat is a little bit concerning. Equipment posts down slightly. Load to truck ratio, not a lot of movement, sitting at about 3.05 loads per truck. And in flatbed, load post volumes continue to track at around half of what they were in 2019, down slightly last week. Carrier equipment posts were down 7%. Load to truck ratio was up slightly from 6.99 to 7.11 loads per truck. Having a look around some of our markets, starting off in the Southwest, after dropping 7 cents a mile over the last 3 weeks, dry van outbound capacity tightened slightly in Phoenix. That's a large warehouse market. Rates up a penny per mile to $1.37. That's excluding fuel. Phoenix to Denver loads paying $1.76. That's about 39 cents a mile lower than the August average and about 50 cents a mile lower than this time last year. Arizona state level rates sitting around 3 cents a mile below 2019. And in Los Angeles, spot market rates are up a penny per mile, averaging $1.72. Ontario next door, rates dropped for the third week to an average of $1.80. And wrapping up our dry van, look at the market, large Midwest markets here in Joliet and Chicago. Prior 3 weeks gains were erased last week, rates down 5 cents a mile to an average of 204. In the refrigerated market, outbound reefer rates in Georgia have dropped almost 60 cents a mile since the July 4 break. Although they were flat last week at $1.94, they're sitting around 9 cents a mile lower than in 2019. Regional loads, we see a lot of spot market volumes between Atlanta and Orlando. We're paying carriers $2.77 a mile last week. That's down 13 cents a mile on last month's average, even though loads moved were up about 2.5%. In New York State, at $3.07 per mile, reefer outbound average spot rates were flat last week, even though some solid gains were reported in Buffalo, one of the smaller markets in the state. Rates were up 5 cents a mile to $2.92. And in Philadelphia, the number 2 port for refrigerated imports, rates decreased 3 cents a mile last week to $1.96. And in the Pacific Northwest, fall produce season continues. Outbound Washington state rates average $1.86 per mile, up another 5 cents per mile week over week. And having a look at flatbed, after dropping 21 cents a mile over the last 7 weeks, state average outbound rates in Texas increased 4 cents a mile last week to $1.96. Houston, one of the biggest spot markets in the state, outbound loads paid carriers an average of $2.05 per mile. That's up 5 cents a mile in the last 3 weeks. On the high volume spot market lane to Lubbock out of Houston, out in the Permian Basin, rates continue to fall though, averaging $2.20 a mile as oil rig counts drop 18% below this time last year and the lowest number of rigs drilling for oil and gas since February of last year. And in Portland, outbound capacity tightened last week, following a 34 cents per mile rate increase, averaging $2.37 per mile for flatbed carriers. And wrapping up our year-over-year look at the market with spot rates in dry van at just over $1.57 a mile. Dry van line haul rates are 15% or about 28 cents a mile lower than this time last year, down 3 cents a mile last week to $1.57. And as you can see from the chart there, last week's national average is identical to 2019 when you look at the convergence of the green and black lines on the chart. In refrigeration, having a little bit of a look at some of the fall produce markets, the capacity, when you look at the USDA, how they report capacity, there was a loosening of capacity in key growing regions that the USDA track in the 2 big markets for reefer carriers, Pacific Northwest and California. Capacity has increased 16% compared to this time last year in the 2 regions that account for just over half of the national truckload volume of produce. Also, a surplus of trucks reported on the southern border. So rates dropped last week down to $1.93 per mile. That's about 29 cents a mile lower than this time last year. And lastly, in flatbed, after remaining flat over the last 2 weeks, last week's flatbed line haul rate decreased by a penny per mile to a national average of $1.91. That's about 24 cents a mile lower than this time last year and sitting about 4 cents a mile higher than in 2019. That's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update, and our weekly report will be uploaded later this evening. And now it's back to Ken for the short-term forecast.
Thank you, Dean. So let's take a look at the short term this week. As Dean mentioned, we always start with dry van. This always excludes the fuel surcharge, so it's base rates only. We give a bit of history to show context. So this goes back to 4/1/2023. The blue line is history, so it's a 7-day weighted moving average. And then we have 4 models to show. We have a green, which is our ratecast model. It is the one that's used in all of our products. It's our flagship. We have a red, which is our short-term model. It more heavily weights what it's seeing in the near term and doesn't pay as much attention to seasonality. And then we have a gray and a yellow, which are sort of intermediate models that straddle the two in terms of long versus short term. And as you can see here, it's a story that you're going to see 3 times, so we're not going to spend a ton of time of it. The models are in agreement. I believe, honestly, overly pessimistic. I do think we'll see things start to improve by mid-October as we start marching more towards the retail shipping season. But again, this is where we blend the technical models and what they output with our own expertise and experience. And sometimes we get it wrong and the model gets it right. Sometimes the model gets it wrong and we get it right, but more often it's kind of in the middle, where the model is blended with our own experience to give a more holistic output. That being said, let's go to refrigerated, same basic deal, down and to the right. Raycast has it pulling out of its nosedive a little bit anyway, over the next 25 days or so. And again, I think it's important to note, these are very condensed ranges, if you will. So, this looks like it's falling off a cliff, but if rates are currently at $1.94 in this chart, Raycast only has it through the forecast horizon going down to $1.90, which 4 cents a mile is not 4 cents that truckers can afford at the moment. But just to call out, that's not like a 20-cent dip. And then let's go to flatbed. The reason you're seeing these follow this trend is more indicative of a long term, which is almost why over the first 25 of the 35 days, all models are almost identical. And then you start to see a little bit of a difference just because Raycast wants to pull out of that nosedive, and the short-term forecast isn't having it. It's continuing to have it down and to the right. So that being said, that's our short-term forecast. We did the long-term last week. If you would like a view of those, let us know on askiq@dat.com, and we'll send those over. But we're going to keep monitoring this as we get closer and closer to the holidays. So let's bring Chad back for our question of the week.
Yeah, thanks, Ken. So, Chad, it's RFP season where contract rates are negotiated for next year's shipments. According to, I think, your Benchmark IQ products, shipments are in the contract market sitting at about 85% of total loads moved, 15% contract, give or take. So, given it's RFP season, tell us, how do shippers go about buying transportation?
Yeah, so you're exactly right. It is RFP season, so shippers are preparing those RFPs and getting them out to carriers and brokers right about now. We see about 40 to 50% of rates go into effect in the first quarter. We see kind of a peak of those going into effect around February and March in our data. I think that's just traditionally been because you get that slowdown in January that helps you prepare for the implementation of a changing over of carriers if needed in that network RFP. So as I think about I'll just frame up like an average shipper in our customer network. So we have a wide range. We have shippers in our network that have $5 million of annual spend and some that have $1 billion of annual spend. So in our total $150 billion of annual contribution data, our average shipper might be about $100 million, nice round number. They might utilize about 100 asset-based carriers that they're directly contracted with. And then maybe 10 brokers to access flexibility. So about like you said, 85% of their freight is running week in and week out on a regular route. And the majority of that is covered by those asset-based carriers that have that drop trailer capacity. And most of that is handled through an annual RFP. We see about over 70% of our shippers say that they are procuring through an annual RFP process. Brokers participate in that as well, obviously. And even the small carriers. So that 100 asset-based carriers, you've got your big 5 that are probably participating in that, and then that long tail of smaller carriers. And almost every shipper I talk to sees a lot of value in those small regional or local carriers in their network that have that perfect fit around a plant or something like that. So those annual RFPs, even with some of our larger shippers, long lead time, they're preparing them now. They're going to implement them in Q1, February, March. And so it takes a while. It's a big lift. It's a big process to get all that data ready, get it cleansed, get it out to market. So one of the areas that we help shippers is tracking their performance to those RFPs through some of our data analytics as well.
Yeah, it's interesting, right? We launched our RFP tool a year or so ago, and we're seeing a huge uptick in usage, right? I mean, it remains fairly constant through the year, but there's certainly seasons, if you will. And this is definitely one where we're seeing August and September and now so far in October, we're seeing it really ramp up in terms of usage of that RFP tool. So I think it corroborates what we're seeing and hearing.
Yep. Yeah, that makes perfect sense that they would, carriers and brokers are probably starting to get those RFPs and having to respond to them on deadlines and things like that. So
for sure.
Yeah.
Hey, Chad, one of the things that was evident last year were the shippers were not so much adding small volume lanes into their RFPs. They were making a more strategic spot market buy. Has that trend continued where, they pass out high volume, low volume lanes and include some in an RFP and some not?
Yes, we definitely see that in our data. So if I look back at the trough of the market in 2020, about 11% of volume was purchased through spot irregular rates as we measure them. And right now we're sitting at 16% using that same metric. So we're seeing more volume going through the spot market than we did in the last trough market. One trend that we do see is about 40% of our shippers say now they're procuring spot freight through a direct API with a broker. So when spot rates are lower than contract rates, they can see an advantage where they may make an award to a tier 1 carrier. But if that tier 1 carrier rejects that tender, they can go direct to a spot market scenario. This only works on live load trailers, typically. Very difficult to cover something like that with a drop trailer. But we are seeing a pretty big uptick in that type of interaction between shippers and brokers. And then, that freight's going to roll down if the broker has a direct contact carrier that they can utilize on that lane. Great, they'll put them in place, or that load is going to end up in, maybe the DAT load board.
Gotcha.
Yeah. So we do track that. I can share that with you in our dashboard if we want to pull that up.
I think.
Yeah. So this is our new Benchmark Analytics dashboard that I have pulled up here. So this is initially a shipper product. We are in development right now to build a broker version of this as well for our customers. So I'm using demo data here. So what you see here would be what a typical shipper would see reflecting their contribution data. So right now I'm opened up to all time frame. You can see down here, the data is going all the way back to 2016. This gives a really helpful view of the boom and bust business cycle of the market. So you can see what their total cost over this time frame loads and just some high level stats. They can measure how their rates compare to the market or to our benchmark over time. So right here, so what we're doing here is we're benchmarking at the load level and then aggregating those results up. So this is to say in this example here for 2023, our demo company is 4.6% below our benchmark. So that would be good performance that they could report throughout senior management and hold themselves accountable on their RFP performance. We break this out by spot and contract over here to the right as well. And you can see that mix that you referenced here, Dean, and you were spot on, no pun intended, about right at 85% for all contributors in contract and spot at 15%. This is using our metric that measures irregular rates. One of the things I've learned since I came from the shipper world over into the data side of the world is each shipper defines what a spot load is a little differently. So we have a algorithm that we use to measure that, but we also let our shippers use their own spot flag that they contribute to us in their data too. I was going to point out to you, this trend line here is measuring the market boom and bust cycle, as I referenced earlier. One of the things it has here in the tooltip and the lowest row there is the percent of spot loads. So you can track this over time. So that's that trough in the market that I mentioned earlier, May 2020. And so 11% of shipments in the spot market at that point in time. The peak of the market here in January of 2022, 20%. So it shot up significantly. This is a point in time where shippers are doing everything they can to avoid the spot market because spot market rates are much higher than contract rates at that point in time. Now that spot rates are lower, we're seeing, it come down a little bit, but they're using them strategically now. So they're using them where it benefits them and where they find fits in their carrier networks. So this also gives them the ability to measure year-over-year change. So like the trough that I pointed out here, all members, we're using an index approach here. So I didn't mention the gray line is all contributors' data. The purple line would be our demo company's data. But you can see at this point in time, all members are 4% to that index, May 2020. And if I find May 2021, 36%. And what I can do is just flip this over to year-over-year change and measure that peak of the market right here. So May 2021, 32% inflation. What's really cool about this, and I'm not aware of another index in the industry that does this, but it's the full combined impact of spot rates, contract rates, and including the mix between the two. So we talked a lot about the mix earlier. So it's taking all that into account. So from a year over year perspective, we're seeing deflation starting to flatten out a little bit. A lot of that is because the base is starting to come down. As we saw in the previous view, we're starting to see that flatten out. So, but we are still seeing continued reductions around 18% from total shipper procurement, and that's again that mix of contract and spot freight.
Is that inclusive of fuel, Chad? Like how should shippers think about the fact that, I mean, I can't word this any way else, but they'd be saving a lot more money if fuel wasn't kind of at historic highs?
Yeah, so that's a great question. I get it in almost every customer call. So we do normalize for fuel. So what that means is we make an all-in comparison. So we take the shipper's reported line haul plus fuel, that's all in, and then we compare that to our benchmark plus fuel. And so that normalized for fuel. So a shipper that pays $1 per mile in fuel is going to have a level playing field with a shipper that pays 50 cents per mile. Yeah, so fuel surcharge, probably a whole other podcast all to itself, as complex as it gets with the pegs. And
I don't want to open up all OX again, please. I don't want to have to remedially explain basics again.
Yeah. So, but it's all solved for in here. Yeah.
Yeah, it's a really great. It's super snappy. I think it's a great way to kind of get what you need really, really quick. I think the team's done a great job with it. How would you? Using this tool, I think we all expect, let's just use it because it's easy, like a 12-month procurement cycle. I know a lot of shippers have changed that, so let's just not litigate that right now. Let's just say you're old school, you bid on a 12-month cycle, your RFP events coming up in October or November. Pretty sure the market's going to come up, right? You're going to pay more on this contract than you did your last, right?
Yeah.
How would you you've been in the chair at a shipper, you're now on the other side.
Yeah.
Luckily for us, right? How would you guide that shipper into how they should be thinking about get the responses they're getting, and how to select and kind of guide, because there's a lot of guidance that happens. What would you offer?
Yeah, so it's a combination of tools, really. So what I've just shown you here is a great tracking to the results of that RFP, right? If I give you a quick sneak peek of our new rate view application that's in beta as well right now. So these are the same rate view rates that you're used to seeing in the legacy application, displayed in a better way, we believe. So when you're making procurement decisions using benchmark rates like this, to understand the results that you're getting, what a lot of shippers do is they will do a batch download of these rates and upload them into their RFP tool and just use like DAT as a scat code. And then that way they can see kind of where the benchmark is falling within the rank of the bids that they're getting. And it's a really helpful data point for them. So that supports that RFP process, and helps them kind of triangulate how they want to negotiate that rate. And a lot of it too is understanding, there's a benchmark rate. That's a reflection of what other shippers are paying in the market, and then understanding how your freight may differ from the norm. So if you have some unique characteristics about your freight, if you pay your carriers in 120 days, or you have 6-hour wait time, but you don't pay dwell, you're going to have a different freight cost on your line haul, where carriers and brokers are padding their line haul costs for those different freight characteristics. So understanding that is super important too. This can help with that, right? So, and we talk shippers through this when they get the first view of this back. And if a shipper sees, well, I'm always 10% over, it's talking through and using these filters that you see over on the right-hand side to help them understand what is it that's unique about your freight that makes it cost a little bit more than the benchmarks that we're seeing. So they can look at it by number of drops, by hazmat, by service level. If they're using drop trailers or live. We can look at volume variability, consistency of lanes, what their distance bins look like. We can really start to drill that down and parse it apart and determine what's unique about your freight characteristics. I know I'm giving you a long answer here, Ken, but I would follow that back up with then tracking the results of that RFP in a dashboard like this, where you're on a regular basis drilling into, show me the last 4 weeks, show me what my results look like. Oops, sorry about that. And watching these trends, because you have a plan, you have an RFP award, and then you put that into place. Well, the volumes aren't binding. The rates are binding, right? The carriers have agreed to the rate. They've agreed to a volume, but that doesn't always stick, right? And if they start falling off that volume commitment, your rates can start going up pretty quickly. And that's exactly what happens in a tight market. So keeping a close eye on that, and they can drill down into, show me the most recent week of activity, and then drill down into what lanes on my most recent week of activity are the highest impact over benchmark, what carriers are running on that lane that I could work with to lower my rates. Is this carrier slipping on their commitments? Those sorts of things. So that ongoing routing guide maintenance is really critical too.
Chad, one of the questions we often get is about, it's kind of a psychology related question. It's about how shippers view capacity. I was at an RFP event last year, and one of the metrics that the shippers were measuring, all of the truckload carriers, was on acceptance rate. And they used the term, they rewarding more volume to carriers and they used the term played nicely with them during the pandemic. I'm just wondering about what's the relationship between service and price? Like, obviously service is important to a point, but then we see a lot of shippers dive into the spot market with that transactional play. How do they think about that decision of balancing service and price?
Yeah, it's really, really critical. When we survey our shippers, 9 out of 10 will tell you service is number one. Mm-hmm. They have to say that, right? That's their priority, is meeting the expectations of the requirements, right? And then price is a close second. So making sure that they're getting the best value for the best service that they can. It's 100% service driven. And so that's kind of goes to those requirements. One of those requirements that can push your rates a little bit higher than the benchmark rate could be your service expectations, your lead time requirements, that sort of thing. And we've got some stuff that can help track that and monitor that for shippers as well. Some of the other things that kind of fall after that shippers are highly interested in is sustainability. So are my carriers SmartWay certified? Do they meet those requirements within my bid? Can I move more volume off of non-SmartWay certified to SmartWay certified carriers? And then there's other things like, are they minority owned, veteran owned, women owned? Some of them have bonusable objectives, the transportation manager, to meet those types of requirements as well.
Right. Chad, one of the questions we also get is, depends on who's paying the freight as to what sort of service a carrier gets. So if a shipper's paying the freight, often you'll get to a receiver and the level of service the carrier gets is totally different. And that's often where a lot of your dwell can occur. So the shippers that are setting RFP rates, does it ever come into the equation, the actual end recipient of the freight and how they impact cost?
So you're asking how much influence does that shipper have on that dwell time in the RFP process?
Well, more the receiver of the shipper's freight.
Right. Yeah. So from my experience, if the shipper's paying the freight, they do have a stake in the game, right? And so they're going to work with that receiver as much as they can to modify that. One of the things I talk to our customers about is when they work through this list of lanes that are over benchmark and fully weighted for volume. So, this lane here would, if I look over the last 24 months, would have $340,000 of opportunity. That may not be because the only outcome of that is not, I need to renegotiate rates with a carrier. It can also be, I need to go talk to the plant that's unloading or the receiver that's unloading this freight and show them this is what's on the table. And this becomes very compelling, especially if it's an internal partner, right? If it's one of your loading docks that you have direct control over, being able to show them the real value, I could reduce costs by $340,000 or $100,000 per year or $50,000 a year. We get feedback from our customers that these are real conversations that they're able to have internally to try to drive some of that change and showing the dollar value of that. Yep.
Got it. Fantastic.
Anything else, team? We're coming right up on the bottom of the hour here.
That's all the questions we've got. I can't see any more in the chat. We've got some shout outs if we want to jump to those quickly.
Yeah, anything else, Chad, though, before we jump on?
No, I think that's it. I appreciate you guys giving me the time again to go over this. I look forward to bringing you more as we kind of continue to develop this out and get feedback from customers. I appreciate the time. Yeah.
Yeah, if I assume if you're an existing customer, it's very evident how to get a hold of you to kind of get information on this. But if you're not an existing shipper customer, how can they reach out to get a demo or follow?
Yeah, best way is just to email me directly. It's easy. It's chad.kennedy@dat.com. Yeah, love to hear from you.
All right, Dean. Plugs?
Robert Rouse is on Landline now, as always. Tomorrow, 7 p.m. I'm at the Journal of Commerce Inland Conference here in Chicago today. I'll also be at Freight Fest in Houston later this week. Also on with Radio Nemo and Jimmy Mack Thursday morning, 8 a.m. on Road Dog Radio, channel 146. Don't forget the latest Freightvine podcast is out with Chris Kaplis and Kelly Abney, Chief Logistics Officer at the US Postal Service. Of course, DATCon is on October 10 to 12. And on next week's show, we have a very special guest, Peter Wise, CIO at ATS, former senior executive at Matson. He'll be talking to us about leveraging technology in the supply chain and becoming a modern 4PL. Back to you, Ken, to wrap up the show.
Yeah, I mean, I'm wearing my swag. I was at Werner's Carrier Connections last week. Huge thanks to them for inviting me. It was a whirlwind trip to get down to Omaha, but it was awesome. I used to speak at our carrier events when I was at FedEx, and it's a bit of nostalgia that came right back. It was awesome to see their appreciation for their carriers and to talk to some of those folks. And a lot of great questions, right? I mean, I'm always amazed, ranging from the market to autonomous vehicles to electric, just a ton of thoughtful questions. And I learned a bunch, even in my short time there. As Dean mentioned, DATCon, I believe we're teetering on record attendance for that show with, still 2 weeks more to go. Lots of great content. As you mentioned, we're going to have shippers and brokers together again this year. So that should be a really, really great event. Topics ranging from AI to cybersecurity to bidding and benchmarking, all kind of fun stuff. So that should be awesome. If you use code GOBUCKS, GOBUCKS, I think you get 25% off the price of admission. So I would highly recommend signing up if you haven't already. And with that, we'll see everyone next week at 10 a.m. Eastern on Tuesday. We hope you have a great week. And thanks again to Chad for joining us. Bye, everyone.
Thank you.
Through the course of these next 2 days, there's no better chance for us to get your input and answer your questions in one really great collaborative event.
We have so much innovation going on and so much investment, so I can't wait to share this. This is exciting. We're using AI and machine learning and intelligence so you get action right away.
It's about bringing together all aspects of the network to solve your problems.
And we know that you all move faster if we provide that connected experiences for you.
We are trying to make it easier for you to use our products. It's going to continue in 23, and this is a testament to that. With 2 million trucks in our app, all of the stuff in the network, all of the knowledge in this room, we can legitimately change this industry.